folks, and welcome to a Check Onchain update for the 3rd of June. Now, Bitcoin seems to be rebranding itself as a bit of a stablecoin at this point in time, which is a very uncommon thing for Bitcoin to do, certainly not within its character set. But usually speaking, when we get these periods of very low volatility and a pretty high degree of boredom, they actually precede a much, much bigger move on the horizon. There's a couple of good examples. Probably the best one is August 2023. So today, this is the topic we're going to be looking at, what the volatility metrics are telling us at the moment, and some of the examples of what that may look like moving forwards. So as I mentioned, we're going to be talking about volatility, and really it comes from a principle where range contraction, meaning consolidations and sideways trading, leads to range expansion. And then the opposite is true, that range expansion, when you go on a big run, whether to the upside or the downside, the market then needs time to digest that move. So once you understand that markets have to go between range expansion and range contraction, they move between these two different levels, we can start to characterize what type of market we're currently in and make a bit of an assessment of where we go from there. So we're going to look at some of those volatility metrics on a pricing domain. Then we're going to move across and look at the sell side risk ratio, which is one of my preferred and favorite metrics. In fact, of all of on-chain metrics, it's certainly up there in my probably my top 5 favorite metric instructions. So we'll explore that for the short-term holder cohort specifically. And then in part 2 of this video, we're going to go over the derivatives leverage. If you want to get access to part 2, you have to jump over to our Substack. We've got a full write-up that actually explores all the topics we go over today in a lot more detail. But we'll be talking about the leverage and derivatives markets, how that's positioned, and what we're starting to see in terms of the overall positioning and what it means moving forwards. So for everyone who's viewing this on YouTube, please do give us a like, a share, and a subscribe. It really does help this channel grow. We're slowly getting there. We just hit 4,000 subscribers, so we really, really appreciate all of your support. And without further ado, let's get stuck right into the analysis. Okay, so where I actually wanted to start today is just with a bit of a setup in terms of the macro side of the equation. So what we're looking at here is the DXY, the US dollar index, and we're only going to look at 2 of these charts, the DXY, and then we'll look at US bond yields. And the reason why I want to set this up is because markets are at somewhat of a decision point in my view. And I won't spend too much time in the macro because there's plenty of podcasts and different commentators who are doing that. And what we really want to do is specialize and look into where the Bitcoin and the on-chain, the derivatives world is going. But I think this is a really important backdrop. Now, really, there's 3 primary assets in the world. There's the dollar, there's the US Treasury market, and there's oil. And those 3 really are responsible for a very, very large majority of tighter or looser monetary conditions. Now, as we know, Bitcoin tends to perform very well during looser monetary conditions because it's essentially a hedge against debasement. But also, it's also in that bucket of risk asset for many investors. So it has quite broached that line between the risk off and the risk on. It kind of straddles between the two, depending on what kind of risk we're talking about. Because you could argue that if there's kind of stress in the traditional financial system, then Bitcoin is obviously a hedge towards that as well, being an alternative as it stands. Nevertheless, there was 2 charts that really caught my eye this week. The first one is the US dollar index. And just based on this very, very simple trend line, right, we're not doing any kind of special TA here. It's at a bit of a decision point. Wherever it breaks higher, because all countries and corporations have their debt denominated in USD to some extent, a higher or a more expensive dollar makes those debts harder to service. And of course, a lower one, if we were to break down below this trend line, that would tell us that we're starting to get into slightly easier financial conditions. If the asset that your debt is denominated in gets cheaper, then it's easier to pay off that debt. Now, the reason why I want to set this up is because we're in a low volatility regime, it's very, very difficult to read on where we're likely to go. And that's what we'll be covering in the back half of this video. So trying to understand a bit of direction, having a bit of a macro backdrop is not the worst way to just get our head in the game and say, well, what happens if downside is a real risk? And if we're looking at the DXY breaking higher at this point in time, that could potentially tell us that we've got a tighter financial condition. At the moment, it is in an uptrend. So you could argue that the preferred direction for this to go would actually be higher. And I cover a lot more in the Substack article, my general views on kind of what the, whether I expect this to weaken over the medium and long term. But we'll just leave it here that we're starting to set up a story that if we got a continuation of this uptrend, it would arguably be a tightening of financial conditions, and that could impact risk assets like Bitcoin, equities, and arguably the rest of the world. Now, probably the even bigger story here is actually US bonds, because US Treasury bonds are essentially what underpins the financial system. And really, they are the base collateral. And what we're looking at here is two different traces. In the white is the US 10-year bond yield, and in the blue is the TLT long bond. Now, essentially, prices of bonds and yields are inversely correlated. So in many ways, these are showing more or less the same chart. One of them is price in blue, the other one is yield in white, because they move opposite to each other. So these aren't diverging, these are doing the same thing, but just to kind of set the scene, because some people may not be overly familiar with how bonds actually work. Now, why did I flag this? Well, similar to the DXY, the US 10-year yield is in a fairly robust uptrend. It has been for most of 2024. Now, we've had a bit of a pop higher, and as you can see, we're getting up towards this zone where previously, as it approaches that 5% yield, which means that the bond prices are falling, and remember, this is the base foundational asset of the global financial system. If we get a fall in prices of the kind of de facto savings vehicle for the world, then that means that it's also harder to service their debt. So we've got bond yields going up, bond prices trading lower. Now, I'm of the view that inflation is likely to remain sticky. I think higher for longer applies not only to the Fed funds rate, but also to long-term bonds, but also to inflation rates. So we're seeing that, generally speaking, if we start pushing higher from here, the bond market is one of the few asset classes that can kind of call time on the rest of the world in terms of risk assets, because it's the thing at the bottom. So if the foundation is shaky, then the rest of the system is shaky. And even if Bitcoin is a genuine answer to these things, it's not in the immediate term, right? It needs to go through, it's just too small. And many traders will see it as a risk on asset and have their algorithms and all their trading bots set up to do that accordingly. So the reason I wanted to start here is that if we continue to see bond yields climbing higher, that risk of stress continues to grow within the system. Likewise for the dollar. If the dollar keeps going higher, or oil, which at the moment is range bound, but if oil also broke higher, all of these things are a sign of stress, or they induce stress into the economy. And as a result, downside is something that we should, at the very least, have in the back of our mind, despite the fact that Bitcoin remains within a quiet and trending and relatively stable macro uptrend. So just kind of setting the scene, starting with a bit of macro, just to kind of get our head in the game as we move forward. Now, a big reason why we want to think about things from this perspective, right? Why are we starting with macro? Well, at the moment, Bitcoin isn't doing very much. And I think that's an important thing to note, right? So what I've got shown here is realized volatility for Bitcoin. And we're looking at over the last cycle and a bit. And what we can see here is we're actually seeing a massive drawback. We've actually got a very, very low volatility for Bitcoin at the moment. It's essentially turned into a stable coin up here about $68,000. Very rarely, I mean, you can see here, this is obviously a noisy chart, right? We're looking at a 1 week and a 2 week basis. But nevertheless, very rarely do we really get down and stick at these levels. Generally speaking, low volatility. We had low volatility at the 2021 peak, which was followed by high volatility to the downside, right? Range contraction leads to range expansion. We can see it here at the start of we had our initial trend lower. We started to get volatility compress, and then bang, it exploded higher as the market traded lower. We saw it here after the FTX event. We saw volatility get down to very, very low levels. This was some of the lowest volatility that I recall, and we exploded higher from there. Now, one zone that I actually want to zoom in on and have a little bit of a look at is August 2023. This was an important level and is arguably one of the ones that this whole environment reminded me quite a bit of this August 2023 level. We saw volatility get extremely low. And again, Bitcoin went into a bit of a stable coin. It basically went nowhere. And I wrote a report back here where I was talking about the low volatility and many of the metrics we're about to cover in terms of derivatives and options markets and those types of things, where things went extremely quiet. And then it stayed quiet for a whole nother week. So I went down that rabbit hole again and looked at things from an on-chain perspective. And that's what we're going to cover in the next couple of charts. But what we essentially did is it went to sleep, and within a day, it traded down 12% and then consolidated for 12 months. Now, this was a high volatility event. It essentially went from doing absolutely nothing to exploding lower. Options premiums blew out. It was a whole big thing. And there was a whole lot of realized loss occurring down here. Now, An important note is that obviously this didn't kill the bull, right? We actually continue to trade higher. But under the surface over here, there was a huge amount of realized loss. A lot of people panicked thinking that this was a lower high and that this 2022 bear market was not over and that we were actually heading even lower. So there was a lot of fear and pain back here. So that's why I'm using this as a good example, because we managed to actually establish a floor and keep going despite that. So as we've got this extremely low volatility, we've seen this, decline, we've basically gone into a stable coin. The market is reaching a sort of equilibrium. These are very interesting points in time, and we can certainly garner a lot of information. Let's keep going with the story. Now, if we look at things in terms of volatility measures, right? Realized volatility is obviously one way we can measure it. What I really want to do is understand, where have we seen similar conditions? So what we're looking at here is the Bollinger Bands, right? Just the classic 220 Bollinger Bands. But what I've flagged in orange or yellow in these zones is areas where the market had a lower, right? The range between the upper and lower bound was even tighter. So we're talking about higher periods of low volatility, right? Even more squeezed Bollinger Bands. And what I want to highlight is there's kind of two market regimes that certainly stand out to me here. The first one is the 2016 early bull and the 2020 early bull, right? Periods where we've recovered from a pretty nasty bear market and we're kind of a lot of sideways chop. And in many ways, 2016 is not dissimilar to where it feels like we currently are. Chopping sideways, 2020, we had March 2020 sell-off event, and the market just had to digest, right? We had a bit of a ranging period, and then we're going into these contractions where it's, compressing and digesting the move. The second area that shows up to me is where we're here in 2018. Right? These zones of late stage bear markets, which usually go into the early phase of the bull. So you could kind of argue this is all one and the same, but late bear, early bull, late bear, early bull, early bull back here in 2020, late bear in 2022, the very, very end. So this is right before and then right after FTX. And 2023, much the same as 2016. So these are the kind of regimes that we're talking about. We're not talking about full-scale euphoric bull markets. Notice how they're notably absent. And we're also not looking at the highly volatile final bottoms that kind of close everything down. We're looking at those two bookends, late bear, early bull type phase. Now, another way that we can look at this is by the 30-day price range, right? So the high and the low. And again, we're looking for periods that are tighter, right? We've got less volatility or a smaller percentage price range, and the same zones show up. We've got here in 2016, 2023. We've got late stage bear in 2018 and then into 2019, right? There's a bit of a trend here. We're talking about quiet and trending uptrends and the late stage before major capitulation events. Both of these two events really show up as low volatility. Now, if we think about this from a market structure perspective, quiet and trending bull markets like we're at the moment, some of you may have experienced this, it feels like boredom. People are actually bored and we're a stone's throw from all-time high. It's quite remarkable, isn't it? There's also the after effects of a major capitulation event when people are just a bit shaken, trying to work out, which way is it going, and it's a bit of seller exhaustion. And also right before a capitulation, we also have these periods of seller exhaustion, right? The market's not really sure which way it's going to go right before FTX, super, super quiet period, not much is going on. And then bang, we get major sell-offs. And again, August 2023 shows up again within this zone. That's the reason I'm going to keep referring back to that one. So moving across to the on-chain side of the equation, if there's one metric that I want you to take away from this session in the on-chain world, it's this one. The sell-side risk ratio is one of my personal favorites. It's such a brilliant construction. It's so simple, and yet it is so effective. So the way to think about how we construct sell-side risk ratio is we look at all of the realized profit and all of the realized loss in USD terms, and we divide it by the realized cap. So if we just take an engineering approach here, realized profit and loss are coins that people think, because remember, these on-chain metrics come from the perspective of existing holders, right? That's how you print an on-chain metric. You need to have the coins at some point in time. You're either receiving them or you're sending them. So for this instance, we're looking at people who are spending. And if they're spending in a profit or a loss, either of those two circumstances, in profit means they think the market's overvalued, so they're taking chips off the table. In loss, if they're spending coins in loss, they're fearful, they're panicking, they think the market's going to go lower. So if we're adding realized profit and realized loss, think of these as the disturbing force. These are coins that are moving that think the market is not at equilibrium. And we're dividing that by the realized cap, which is the size of the asset. So in the numerator, we have the disturbing force, and in the denominator, we have the resisting force, or the size of the object that's trying to be moved. So within that context, and here we're looking at short-term holders. Let me just move myself to the top here because we'll look at the left side of the chart. So if we're looking at the short-term holder cohort, and the reason why is that this is the cohort who really drives near-term price action. So during these events, this is really what we're looking for primarily. If we're looking at short-term holders and across all sell-side risk ratios, high values means that the market is not at equilibrium. Lots of profits being taken, typically near bull market tops. You can see sell-side risk is very often high during tops because we have lots of people who think the market is overvalued and they're taking chips off the table, right? Sell-side risk is telling us about existing holders because they're the only ones who can sell. So when we have a high value, the market is unstable. Even though it's trending higher in either direction, it is unstable. We also see near capitulation bottoms, we get large spikes in sell-side risk, right? Here's FTX, large spikes. Generally speaking, those spikes aren't as big as bull market tops, but they do represent people who are fearful and the market is not at equilibrium. It is moving in some direction that is motivating people to spend their coins. Conversely, low values are actually a volatility. Well, this whole metric is a volatility indicator, but they are telling us that there is no volatility. They are a low volatility indicator because the profits that were going to be taken, look here at the 2018, right before this capitulation, all the profit that was going to be taken from the previous bull has been taken. All the losses from the previous bear have also been taken. So within this tight little trading price range, all the traders and investors who were going to take profit or were going to take loss have done so. So as a result, it's telling us the market is at equilibrium and it has to move somewhere to motivate that next round of spending. Now, in this instance, it happened to be a 50% sell-off, right? So these things can happen where it's in both directions. We can also see here in FTX, we reached a very, very low level and then we ripped higher because essentially we'd reached seller exhaustion, which is why we call it sell-side risk. It's not telling us about the direction. It's not telling us that it's bearish or bullish. It's telling us that low volatility or range contraction leads to range expansion. And we can see this in the on-chain domain as well, where we're basically saying that right now, in log scale, by the way, sell-side risk ratio is coming from a very high value, a local or a global peak. Again, we'll never know until we break above it. Local or a global peak trading down in log scale to very low values. Now, we're not the lowest that we've ever been, but we're getting towards the lower bound. This is where things are at equilibrium, and therefore it's time for the market to move. So that's where we're going to leave part one of this video. If you enjoyed it, please do give us a like, a share, and a subscribe. And let me know in the comments what you enjoyed and what you want to see more of. And for everybody else over at Substack, let's continue on to part two, and we'll have a look at derivatives and what's going on in the leverage space. So thanks, folks, for tuning in for part one of our weekly analysis. If you enjoyed the video and you want access to the full video and the rest of our analysis, do head over to our Substack and hit subscribe. As a paying member, you'll actually get access to a second piece of analysis each week, as well as the comment section where you can ask me questions and we'll answer them in a Q&A on a regular basis. So thank you so much for all of your support. We hope you enjoyed it, and we'll see you in the next one. Cheers.